Loblaw sales and profits up year over year. The gain on food sales may be smaller than analysts had expected, but the rest of the business doing just fine. Let's get more from Tony Ciero, VP and Senior Portfolio Manager at Caldwell Securities. Tony, great to see you. Thanks very much for joining us. Give us your reaction to the Loblaw's report, please.
Yeah, steady earnings. We anticipated this. Slightly higher revenues than expected. I think year-over-year growth was in around 4.3%. And when you're looking at a stable company like that, you're looking at it stays ahead of inflation. A lot of the inflation, the cost of groceries are passed on to the consumer. That won't be eaten up by the big companies like Loblaws and Metro. Consumer staple companies. So that's something we expected. It's inflationary, and the growth is, again, due to the inflation. The no-name value brand is an area that did quite well. Only in a rising rate inflationary environment, consumers are looking for lower prices on groceries. So Loblaws was exactly what we expected from an earnings standpoint.
Would you be a buyer of Loblaws, or is all the money that's going into it pretty well there?
Yeah, we are buyers of Loblaws, and again, it helps. It's an inflation protection. That cost, the higher cost of goods, are passed on to the retail, the consumer. So yes, we're always considering Loblaws for our clients' accounts, and sometimes it could even be a cash replacement, because it does pay a little bit of a dividend, roughly about 1%. But again, you stay ahead of inflation.
That's interesting. You feel the stock is predictable enough that it almost resembles cash as a sort of holding place for money.
Yeah, and it's great. Investors generally go to cash also when markets are a little frothy and potentially have decline going forward, and a consumer stable like Loblaws will generally do well in that type of environment. So that's the reasons why we buy it. It's more of I want to say a risk minimization as part of the portfolio. And a company like Loblaw, even if you look at George Weston and Metro, generally stay ahead of inflation.
What about the CAE numbers? Of course, if there's a massive increase in countries wasting money on weapons, it's going to be good for CAE.
Yeah, that was a surprise. And then the earnings per share came in around 17 cents, and the expectation on the street was about 14 cents. So a surprise to the upside of 22%. We anticipated much what the rhetoric is out there. Their utilization rates, and if we look at the civil aerospace side first, that's generally their bread and butter, so the pilot training simulation. Because there is a shortage of pilots globally, a lot of pilots also retiring because they're hitting the retirement age. Utilization rates for the simulators are not as high because they're not being used. So the anticipation was earnings will be lower, a lot lower compared to this time last year. But at the end of the day, it was slightly lower. On the other side of defense contract, they're looking at replacing some of those old legacy contracts that are not necessarily profitable with new ones, especially as you mentioned. Quite a bit of spending globally on defense. One more thing I want to add, and I apologize for interrupting. It's what's next for this stock, and that's what we're looking at it. You can argue the government shutdown in the U.S. will be sort of a slowdown. Maybe next earnings we can see a little bit of headwind there. But that'll be transitory. It could easily be offset as utilization increases. So you have to hire pilots globally. And so the civil aerospace pilot simulation programs will increase. And again, as I mentioned, the defense spending notion across the world, the US, Canada, Europe, CAE should benefit from those contracts as well.
Of course, I say wasting money on defense. We may need to do it in a more dangerous world, but it's a pity we couldn't be spending it on hospitals and ice rinks and fun fairs and things that actually contribute to the quality of life. There does seem to be some softness in the civil side of the business, though. Apparently, according to Desjardins, a slower than expected recovery in pilot hiring.
Yes, exactly. You've had, coming out of COVID, there was not a lot of use for pilots because airplanes were grounded. Now you need to ramp up, but it coincides with a lot of pilots retiring, hitting the retirement age, and you need to replace. And it is an industry for potentially, if you enjoy planes and flying, that you might want to consider over the next 5-10 years if you are looking for some type of employment, looking to enter a career. Because we think that's going to be a hiring spree lasting for about 5 to 10 years to replace the demand.
Thank you very much for joining us, Tony. It's always great hearing from you.
Thank you, Andrew. You too. Take care.
Tony Ciero, VP and Senior Portfolio Manager at Caldwell Securities.